Hey everybody, welcome back to the channel. We are back on another episode of the Daily Recap. Today was one of the best days we've had in 2025. Almost 2% green on the S&P 500. A lot of stocks got momentum. Palantir was up 7%. Robinhood was up almost 9%. Tesla was up 12%. A lot to talk about, a lot to break down. There is some nuance to all this green and some things I think people should be concerned about in the midst of the rally that we are having, the potential bottoming that we have just experienced, hopefully at the midpoint of March. But a lot of things did happen today in regards to tariffs. I know we talk about it every day, but we got to keep talking about it in order to understand what's going on with the broader markets. And we got a couple other headlines that we'll get into in regards to Bitcoin, MicroStrategy, Apple, big tech companies. Lot to get into. Let's get into it. Okay, so let's start off with our first point of the day, which is tariffs and the string of events that happened today that created the volatility that we saw, even though that volatility ultimately resulted to the upside. So there's a couple of layers to what happened today. The end result of all of these layers is that the stock market did not care about whatever Trump said, even though he tried to say things in a variety of different new environments. The markets went higher, at least today. Maybe that's not going to be the case tomorrow, maybe not the case next month, but at least today, March 24th, the market said, we don't care about what Trump says about tariffs. We are going higher. So let's start at the beginning. Why did the market go up today, and why was it up last night on the Sunday futures? Well, Wall Street Journal came out with an article last night, and they said, we have gained information from sources that the White House is scaling back its broad-based April 2nd tariff plan, this whole Liberation Day that Trump has been talking about, on industries like autos, chips, semiconductors, and pharmaceuticals. So you've got three major industries that are not going to be tariffed to the extent that they're going to be tariffed, or that the extent that the market was perceiving they were going to be tariffed for. On this show, the market open, market closed, my opinion has been that I didn't think April 2nd would be this massive doomsday of tariffs, because logically, I don't think Trump wants to get into a trade war with Canada and Mexico. Like, it just doesn't make that much sense. So from my perspective, it was always like, okay, maybe April 2nd is going to be a little bit lighter than we thought. And as a result, based on the article from the Wall Street Journal last night, it does seem like it's going to be a little bit lighter than what the market thought it would be, which is very good. So that was the good news. That's why the market was green in the pre-market. That's why the market was green last night. It was, and throughout the market open for the first hour, the market was very green. We got a slight red candle, and it was very slight, but it was slight based on what happened here. And that slight red candle was because Trump put out a tweet. What did Trump say? Trump said, hey, I'm paraphrasing, but this is almost verbatim exactly what he said. If you do business with Venezuela, if you buy oil or gas from Venezuela, no matter what country you are, including China, which is one of the countries that buys oil from Venezuela, you will have a 25% tariff put across the board on goods and services. And I mean, this news broke in the market open. I was reading it and I was like, this is absurd. This is insane. Like, there's just no way. There's so many countries that buy oil from Venezuela. Are we tariffing all of them? Spain, India, Cuba, China. Like, are we putting 25% tariffs on all these countries? It made no sense while I was reading it. It felt, quite frankly, in my opinion, like a desperate plea to create some volatility in the markets. And we'll talk about why Trump might want to create some volatility. And I was just like, this is BS. So that red candle, that ever so red small candle, immediately flipped and we started going higher. Because I think the market in that moment read that tweet and they were like, no. We're just like no, we are not, no, we do not think this is how it's going to play out. And so, because it's just absurd, right? Any country that buys oil from Venezuela gets a 25% tariff. So you might be asking, why Venezuela? Because there's a lot of immigration and gang problems with Venezuela, which is an issue that should be dealt with. But saying that we're going to tariff anyone who buys oil from them, at some point it just becomes like not believable, and the lack of legitimacy starts to creep in, which is what's happening with Trump right now when it comes to tariffs. Then throughout the day, Bostic, Fed president, he comes out and he says, hey, I don't think the tariff inflation is going to be transitory. He basically says, hey, I think we should take it more seriously than not, because in 2018 it was transitory for about 7 months, but now based on how Trump is talking about tariffs, it might be even more inflationary than we expected. Again, Jerome Powell said that tariff inflation would be transitory, and he triggered a lot of people because last time they used that word, it wasn't transitory. But Powell and Goolsbee, other Fed presidents, have said, hey, we're good. We think, the tariff inflation might be aggressive, but it will be transitory. Bostic comes out today. Bostic does not have a vote on the rate cut decisions, but still, he is the Fed president, and essentially the market kind of reacted to that. We had a little bit of a red candle when he said, hey, I think tariff inflation might be more than transitory. But even then, it was not enough to stop the market rally, and we continued going higher. This was about 1 p.m. during the day. And then finally, about 30 minutes before the market closed, Trump said, specifically, he did like a ton of different press conferences today with a bunch of different leaders, and so he had to take a bunch of different questions. This was the final comment. He said, "I may give a lot of countries breaks on tariffs." And then the market went higher because the market was like, okay, cool. Like if you're gonna, all right, if we're gonna give countries breaks, then boom, no more tariffs. So I think if you felt skeptical about this April 2nd doomsday that Trump has been hyping up for the past couple of weeks, you've been right with your skepticism. If you bought the dip, so far it has worked out because the market seems to be perceiving Q1 earnings growth to be strong, consumer confidence to be an issue, but not an aggressive issue, recession risks to be off the table, rate cuts to likely be coming, at least 2 of them by the end of the year. And then the final overhang on like, can we make this a bull market? Is, do we have to deal with this tariff trade war stuff? And if April 2nd is going to have, some reciprocal tariffs, but it's not going to be full on trade war, then buying the dip over the past couple of weeks has made some sense. So that's what happened today in terms of tariff volatility. You had Trump say a couple of things that were kind of bearish. Market did not care, especially the Venezuela stuff. The market moved past it. The S&P 500 did reclaim its 200-day moving average. I hope you text your mom, your sister, your father, your girlfriend, your sister-in-law, like your best friend, tell them, even if they don't care about the stock market, just tell them, did you know the S&P 500 regained its 200-day moving average? I mean, you never know. Maybe people will start getting interested about the stock market if you ask them this random question about if they knew the S&P 500 reclaimed its 200-day. But the point is, the market just didn't care. The market just kept going up because like it was done with a lot of this tariff volatility. And I think the reason today's bottoming feels like a more exciting bottoming process, and again, we don't know if it's the bottom, but it feels like it could be. It's because of the events of today. All the 4 events I talked about that should have been relatively bearish in terms of the headline, like 2 weeks ago, any tariff headline, immediately the market tanks. The market did not care today. And I think the market not caring today was them saying, screw you, we're going higher. We don't have any reason to go lower. We don't believe you're going to do tariffs, or at least the extent of tariffs that you're saying you're going to do. And as a result, the markets ended up getting 2% on the day, Tesla 12%, just an incredible day. Now, the one thing that's been bad about all this is the 10-year gapped up 4.35% today. That's not good. Besant, Lutnick, Trump, they do not want bond yields to get higher. One could argue that people are selling off bonds to buy stocks, which gets yields to go higher. And so I kind of think Trump was instituting some of these weird statements today, especially about Venezuela, to create volatility in the market that can then get bond yields to go down, get people to get scared and start buying bonds. That didn't happen. I have zero clue what this administration's approach is going to be to get bond yields to come down, because JPAL's not cutting rates anytime soon, unless we have like the signs of a recession. We don't have those signs yet. So you've got to get people to actively say, I want to be in bonds over equities. That's not happening. Not happening on a day like today. So the tariffs, I thought, was the key to get you there. Today was the day where the market said, we don't care anymore. Does Trump actually get that aggressive with the tariffs to create that scenario playing out? I don't know, but at least for now, the market is not buying it in terms of this narrative that tariffs will create this massive economic issue with equities that would cause them to get into bond yields, or cause them to buy bonds, which would get yields to come down. So I think that's an issue, because if the administration is hell-bent on getting that 10-year to come down, and you have to create a volatile event to get it to come down, unless the administration has changed their mind over the past couple of weeks, and like now they're okay with the stock market going up, the bond yields also slightly coming down, even though they don't really come down unless you have some pain, or maybe there's a way for them to engineer bond yields coming down while the stock market goes up. I don't know how they're going to do it. If they can do it, that would be like, you would have to give them a lot of credit if they can actually figure that out. But that is the big issue I see right now. What do we do about these bond yields that the administration has told us they want to come down? It's kind of at odds with the stock market. But as a result, we get a 2% green day on the S&P 500. Before we get into Tesla, here's a quick headline on MicroStrategy. They bought another 6,911 Bitcoin for approximately $584 million at an average price of 84,529 Bitcoin. Bitcoin also had a great day, up at about 88,000. Right now, it's just below 88,000, but it was up 3-4% of the day. That helped Robinhood, Coinbase. MicroStrategy was up 10%. Now MicroStrategy owns 506,000 Bitcoin. They own more than 500,000 Bitcoin. They spent about $33.7 billion to get it at an average cost of about $66,000 a Bitcoin. I mean, pretty damn incredible. Okay, next update is Tesla. So a lot of different things are happening with Tesla that I think are very important to kind of get a better grasp of. So first of all, Tesla was up 12% of the day. In fact, it's up another 1% after hours. The market seems to have felt, theoretically, that Tesla has bottomed. And if Tesla has bottomed, then the surge we saw today of about $90 billion in market cap is kind of making the argument that, hey, there is a bigger story here to Tesla outside of the automotive revenues. Piper Sandler came out. They said, hey, brand image doesn't matter. Q1 deliveries are going to be bad, not because of demand, but because of supply chain bottleneck issues, which we have heard about over the past couple months. So that could be the reason for why deliveries would not be good. By the way, the delivery numbers comes out April 2nd. That's going to be a very important day, given we got the tariff stuff as well. And they maintained an overweight rating with a $450 price target in the context of Tesla. So why did Tesla get this much momentum today? Well, I think there's a couple scenarios. I think number one, either retail is smart money and smart money is dumb money, aka retail has decided that we are calling a bottom on Tesla. And if that bottom on Tesla meaningfully did happen at 215, then this is a retail driven rally and a lot of retail is getting rich. Or this is smart money pumping up the stock via algos and manipulation just to dump it on retail. So they're kind of creating this false narrative, which they've done time and time again across a lot of different companies. And as a result, they are getting ready to then slam it on the floor after Q1 earnings, if Q1 earnings are going to be bad. I think there's two scenarios. The other third scenario is retail and smart money both are calling a bottom and everyone's buying in, which theoretically could be happening as well. But ultimately, we're going to find out after Q1 earnings how this plays out. Now, JP Morgan came out with a chart a couple days ago, and they said retail investors have pumped $8 billion into Tesla over the past 13 days, so basically the past 2 weeks, the largest inflow during any buying streak in Tesla's history of being a company, of being a public company. So quite literally, retail has said we are calling a bottom based on JP Morgan's analysis in terms of the amount of inflows that are coming into Tesla. And the question is retail right or is retail wrong? I don't think we know. I think Q1 is going to give us a lot of insight on what's right, what's wrong. Is Robotaxi here? Is Optimus here? Is that really far away? Is that a pipe dream and the automotive revenues are that bad? One thing I will say, though, about the price action is that I think it's very encouraging if you're a bull, very discouraging if you're a bear. Why is it discouraging if you're a bear? Well, if you're short, I mean, you either double down on your short or you got to cover, because this is aggressive price action. This is why the Tesla premiums on covered calls and puts are so juicy, because people love this volatility. Same thing with MicroStrategy. It's just I'd rather, sell options on Tesla, because even if I'm left holding the bag on Tesla, it's Tesla versus MicroStrategy. It's like, unless you really believe in Bitcoin and all that momentum, like at least, you're holding a company with cash flows, all that stuff. But the premiums are amazing. And so that's why you get this type of volatility. But number two, let's say going into the Q1 print, Tesla's at 280, 270, even 265, and there's a 20% decline. Your downside is 210, 205, 215. That was where we bottomed at a couple of weeks ago. If we were at 215 going into the earnings and your downside is 20%, well, you're now below 200. I think if we can maintain these levels, and Q1 sucks, which everyone seems to be pricing in, and it's kind of making me feel that Q1 might not suck as much as people think, but let's just say it does. What, we're going to go down 40% again? Like, no, it would have to be so aggressive. I think that would be discounting way too much. The price action would have to be very, very downward focused. Tesla's still down 30% year to date. So like I think max downside is 20% on earnings, which gets you right back to 220. And then people are really going to buy that dip, because if we kind of double bottomed at 220 and we hold that as a base, I think that gets a lot of people excited. So I don't think Tesla investors are out of the woods, because Robotaxi and Optimus is not here yet. And valuation at the end of the day does matter if you're only a car company. Now, if you're buying Tesla, you believe it's much more than a car company. I get it. But in the short term, all right, if you're paying this aggressive of a multiple on earnings for a company that's not growing, Tesla's not a growth stock right now. It's not growing. There's a perceived qualitative story about their growth in the future that can make it the most valuable company on the planet. That's not happening today. And so the question is, what multiple do you want to pay on that in the future? And if you're willing to pay this multiple, then sure. If you're not willing to pay this multiple, then you wait and see. But I don't know how the street's going to interpret it going into Q1, or maybe Tesla comes out with some really good Robotaxi news, some really good Optimus news, and then all the street analysts have to be like, holy crap, we didn't see this coming. I mean, I think that could very much happen. And it could really shock a lot of people that were pricing in an automotive revenue quarter that was so bad that they forgot about some of the qualitative parts of Tesla that are exciting. So I think Tesla's run was incredible today. I think it's very, very exciting to see. I think it needs to be able to hold this momentum, because we've seen the upside and the downside many times in this way for Tesla. But I do think if it holds this range within 5 or 10% going into earnings, and the downside is 20%, you get back to where we bottomed out before. Unless the earnings is that bad that we fall below 200 and you're down 30, 40%. But I think bears should be a little scared unless they think all of this momentum is pure hype. Then they double down on their short. I think if you're a bull, you kind of sit back and maybe you sell some aggressive or not far out of the money covered calls. I mean, you could sell aggressive covered calls if you think this move is too much, but you could sell a $400 covered call a month from now and get paid $100 a contract. All right, if Tesla gets to 400, you have to sell some shares. It is what it is. And you can obviously roll before that happens. But If there are people willing to pay that much money because they think Tesla can now make a run to 400, which who knows, maybe it can, but if odds are on your side that it doesn't get that high to 400, you can collect some money on the covered call premium. So I think this is really good for bulls. For bears, you definitely got to be staying up at night a little bit of just like what's going to happen. And then for sentiment, if we really did bottom, that doesn't mean we have to go much higher, but that definitely doesn't mean we have to revisit those lows if Q1 earnings is relatively decent. And we'll find out in a couple weeks how Q1 earnings ultimately goes. Okay, next update is on Robinhood. I will be at the Gold event this week. I'm going to be very excited for that. I'll be with Roy and Tanner, my fellow Robinhood weekly co-hosts. So that'll be really exciting. That will be on Wednesday. I'll be giving you guys all the coverage I can. If you just follow me on Twitter, that is in the description. You'll see all the real-time updates. But we did have a piece of news on Robinhood as well today. Massachusetts, which I don't know how to say that word. If you're new to the channel, new to the daily recap, forgive me. I cannot say this damn word. Massachusetts. I don't know how to say it. My lips act the way they act. I can't. I don't know. I can't control it. And I'm not trolling. If you've been on the channel, I can't say this damn word. The Massachusetts securities regulator subpoenaed Robinhood in a probe of college basketball event contracts. So basically, Massachusetts doesn't like that Robinhood is skirting the law. Gambling is illegal in some states. Robinhood is doing derivative event contracts, which is different from gambling technically, even if it's basically gambling, but it's different. And that's how they're able to legally do this in every single state in the United States, which I think is just awesome. I think their legal team just figured out a really cool way to get around this. But Massachusetts came out today and subpoenaed them. So what are the implications of this for Robinhood investors? Well, number one, I don't know exactly what the legal ramifications here are, but my baseline assumptions are, number one, the Robinhood legal team probably knew this was going to happen. There might be other states that try to do this as well. I think their legal team is top notch. I think they're going to be set up to deal with this and they're going to be able to navigate it. Number two, like if people can't bet in Massachusetts on Robinhood, okay, then a few states are left out of the overall TAM, but I still think the broader idea can go global. And Robinhood can still print a lot of money off this. So maybe other states follow. Maybe this is a one-time thing with Massachusetts. Maybe Robinhood uniquely fights back. But so far, the state has not legally stopped them from doing this. They've just issued a subpoena. And so we're going to have to see how this ends up playing out. But I think Robinhood's going to have a way to work around it. In terms of the event contracts product, for those that don't know, 98 million contracts just in the NCAA tournament in the first couple rounds have been traded on Robinhood. Robinhood has printed $1.9 million in the past 7 days off these event contracts. This is a game changer. This is a winner. Robinhood's going to expand this to thousands of categories. This is a brand new vertical they just came up with. I mean, imagine making $2 million a week. Now that's probably not going to happen, but imagine an extra $20 million a year, $30 million a year. I mean, like just in terms of top line revenue, earnings per share, like this is really going to be a product that I think can go global, can expand. If anything, it can pay for all these deposit transfers that Robinhood's doing. They're giving you 2% to transfer from your Schwab or Fidelity to Robinhood. They have to pay you, millions and millions of dollars to get all these assets. If this thing could subsidize, because they're making $2 million a week on this thing in the month of March with March Madness, and they have to pay out $10 million in assets in transfers to get $2 billion on the platform. Like bada boom, bada bing, they don't have to spend any money. It's like it's money they're doing from this that they didn't even expect to get because it's a brand new product, and they're spending to bring over assets, and then all those assets compound in terms of different things they can get a percentage yield on when it comes to their net interest revenue. So there's just so many ways that this ecosystem is evolving. And again, we talked about this last week. People think it's gambling and people think it's the worst thing in the world, and it's like this horrible mentality. I'm just like, dude, I traded one contract because someone told me to bet on Florida. I bet on Florida. I made $30, but like, I'm not doing this because I don't spend my whole life researching NCAA games. For those that want to do that, let them do it. And if they lose some money, yeah, you can lose some money in the stock market as well. So I think the overarching moral concerns people have, they're just not that big of a concern. Printing $20 to $30 million and growing that rapidly a year. I mean, with a brand new product vertical that kind of came out of nowhere, I think it's amazing for investors. And the people that were going to gamble their savings away, their entire account away, they were probably going to be doing something horrible as well. That's an addictive personality that if you're into that, you were going to do that with zero DTEs anyway. But Robinhood's not going to ban zero DTEs. So in my opinion, this is great for investors. The more people that get onto this product that don't even care about investing have a chance to now become investors because they're integrated into Robinhood's ecosystem. And I think on the call, we're going to get a lot more clarity of how many new people, the conference call for Q1, how many new people are coming onto the product that are coming just for event contracts that you can then transition to gold subscribers. I mean, there's so many ways they can navigate this. And then here's one thing people don't think about. This is my last comment on this. If you lose money on Robinhood event contracts, you lose 20,000, someone on the other side of the platform took your 20,000. So I just realized this today. It's like, wait, That's a net. If you lost 20K to John, who lives in Massachusetts for now, took your 20K on Robinhood. Robinhood collected a spread in between, so they collected the commissions. But it's not like that 20K left the app. That 20K just got transferred to the app, which means the assets under custody actually don't get hit. This is different from buying an option, because if you buy an option, someone could have been selling you that option from Citadel. And now when your account goes to zero because the option doesn't print, Citadel makes that money. Those are AUC, assets under custody, that leave the platform. Whereas with sports betting or event contracts, it just switches hands. So, I mean, there is a world where I think this can massively increase through AUC, and it's just a question of how they scale this product. Okay, final headline for the day. 2 stats that I thought were really important. Number 1, the wealthiest 10% of Americans now drive 50% of U.S. personal spending, a significant increase from the 33% they contributed in the 1990s, while the bottom 60% share has shrunk, highlighting a growing reliance on the rich for economic growth, according to Moody's Analytics. I thought this was important because at the end of the day, look, the far majority of wealthy people in the United States, the wealthiest 10%, are driving 50% of US spending. Those people can't lose their wealth or have the perception of the wealth effect where they think they're losing their wealth because their stocks are falling, their real estate, crypto is falling, etc., because they might just not spend anymore. So I think it's showing a bifurcation of 2 consumers in America. One consumer, which is struggling to shop at Dollar General, another consumer that is up, hundreds of thousands of dollars on Palantir and is willing to spend a little bit more on that sushi dinner and give a nice fat tip. Like, these are things that I think we have to think about as a society, because we need to encourage more people to get part of that wealthiest 10%. But we also need to make sure that wealthiest 10% don't feel like their wealth is eroding based on whatever macro situations. That's why a recession is horrible for everybody. Because if that waitress who gets a fat tip from that guy who's up hundreds of thousands of dollars on Palantir is only getting that tip because that guy feels like he has the money to give to that waitress because he wants her number, and also because he has hundreds of thousands of dollars in gains from Palantir, well, then those hundreds of thousands of dollars of paper gains in Palantir can't go to tens of thousands of dollars, because then that fat tip is not going to the waitress. So from that perspective, I think it's really important to make sure that, the broader macro economy in terms of assets, like, stay stable if you own assets. Because if not, which is what happens in a recession, everyone ultimately suffers. Final stat, foreign investors pulled approximately $6 billion from U.S. equity funds last week, marking the 3rd largest weekly outflow on record, surpassed by only March 2020 and the March 2023 banking crisis. That's aggressive. Foreign investors, let me say that again, they took out $6 billion last week from U.S. equities. That was only surpassed by March 2020, COVID, and March 2023, Silicon Valley Bank collapsing. European stocks saw $4 billion in inflows over the past 4 weeks, the highest in 10 years, signaling a shift in investor preference. Now, despite this inflow into Europe and outflow out of the United States, $16 trillion of U.S. stocks are still owned by foreign investors, which is about 23% of the U.S. stock market value. So the foreign markets still own a decent chunk of U.S. stocks. We need to make sure their conviction in our markets stay high, because if we keep seeing this type of a weekly outflow, which I don't think we will. I think last week was a unique scenario, but hopefully not this year. Markets can't stay elevated. But if that much money leaves, then we might have an issue encouraging people to continue betting on the United States. All right, that's it for me. Thank you everybody for listening and watching. Hopefully you guys enjoyed the daily recap. We will not have a show tomorrow because of traveling. I'll be flying in the air, and we'll be back continuing our regular schedule. Market open, market close on Wednesday. I will have a market open tomorrow, not a market close. We'll be back on Wednesday with normal schedule. All right. Thank you all for watching. I think there's one blooper in this episode. I'm getting a little bit better at this thing. So enjoy the one blooper. Take his opinion with a grain of salt, but nonetheless, a grain of salt. What the fuck is a grain of salt?